Weisskopf, go ahead and kick us off.
Oh, what can I say? Today is the happy hour from the ETF Think Tank. I'm Dan Weisskopf, the ETF professor, and thrilled that everybody's joining us on what, well, maybe our last happy hour of 2022. Probably is. Anyway, Dan Weisskopf here, known as the ETF professor, also lead ETF strategist for the ETF Think Tank, where we help financial advisors build better portfolios. So with that, I'm going to hand it off to David so he can add some more color on what he does.
How's it going, everyone? David Chikansky here, fellow portfolio manager under the title Family, focusing on the SoFi Be Your Own Boss Gig Economy ETF and the Amplify Inflation Fighting ETF. I think today should be very good, talking all things kind of global macro, which is quite difficult in this environment. So we're going to see if Russ can provide us some guidance going forward. With that, I will pass it off to Cynthia Murphy. Thanks so much.
Hey, everybody. Cynthia Murphy, head of research for the Tank. Always our favorite day, my favorite day of the week, the Thursdays. Thanks for joining us. Mike, I'll let you go and then you can introduce Russ. Thanks for joining us again, Russ.
Awesome. So let me just start by saying I'm happy to have our holiday edition of the Think Tank. I wore my sweater. Welcome to the jingle. It's been a difficult year for the markets. And yet, as Dan reminded me, we've done very well navigating a lot of it, and I'm very proud of this team. So I'm super happy to see all of you here, and I'm very thankful for all the time you've spent with us in 2022. And I look forward to a much rosier 2023, even though everybody tells us it's not going to be, which is usually when it is. So we shall see. So Mike Venuto, the co-founder of Title Financial Group and chief cat herder of the ETF Think Tank. Today we decided we are going to have a toasting word or a celebrating word. It's going to be conditions, financial conditions, weather conditions. All those things are in turmoil right now, so we'll take care of things. And with that, if you've got any questions, throw them in the Q&A. If you want to be promoted up to panelist and come ask questions directly, just raise the hand or write it in the chat, and we'll make sure to get to it. And with that, I'd like to welcome back our special guest, Russ, a portfolio manager at BlackRock in 3 or 4 different divisions. I'll let him explain it because I missed the acronyms already. But we're excited to have him here. And Russ, please introduce yourself and tell us about the current market conditions.
It's kind of a straightforward ask. Listen, good afternoon, everyone. Thanks for having me back. For those that I haven't met virtually in the previous broadcast, so my name is Russ Koesterich. I am a portfolio manager at BlackRock. I've been there since 2005. I co-manage the Global Allocation Fund, which probably many of you know with Rick Reeder. It's about a 45 billion franchise, multi-asset, kind of go anywhere, do anything. And then I also am the lead portfolio manager for our GA Select models, which are aimed at our advisor market. They are on the InvestNet platform, and again, aimed at providing sort of general portfolios for advisors, anything ranging from 20/80 up to 100/0. And happy to report those just crossed the $1 billion mark. So something we're definitely leaning into in this environment. So look, I'll maybe just kind of kick off with a couple of thoughts about where we are. I mean, one, I echo the thought. I'm glad the year's almost over. I think for just about anybody who's not over 100, this has probably been one of the most challenging years of our careers. And the obvious reason why is we've had something we haven't dealt with in 40 years, which is inflation. And it's not just the fact that inflation's been running hot all year. What really has created such a tough environment for virtually every asset class other than energy stocks is the fact that every central bank was so far behind the curve a year ago. And they were behind the curve because I think they missed a lot of what was driving inflation. Fiscal policy in most places was throwing fuel on the fire. And even as recently as
anyone else here? Oh, we lost you for a second.
And back now?
Yeah, you're back.
Black,
Hey, Russ.
BlackRock's trying to hide their secrets. They heard you talking. They were like, we gotta cut it off.
Was not paying the bill.
Hey,
Right.
Russ, move a little bit closer to the camera too, because you're like really far in the distance. How much better? Thank you.
There we go. All right. So anyway, just to kind of continue with those thoughts, you had this combination of supply chains disrupted because of trade wars, supply chains disrupted because of the pandemic, too much fiscal stimulus, consumers that had nothing to do for a year or two other than spend on goods, and it created an environment where central banks have been playing catch up all year. So, look, we think a lot of the adjustments done, but one thing I'll say is that I don't think the situation changes just because the calendar year changes. In other words, we've been fighting financial conditions all year. Next year, we're going to fight a slowdown as well. Well, I do think there's going to be a good buying opportunity. There already is in areas like credit. The reality is, I don't think we're going to start the year where everyone's got to back up the truck and load up on stocks and other risky assets, because there's some more tightening as the Fed and the ECB and the Bank of Japan made painfully clear over the last week or so. So let me leave it there and see where you want to take it.
Well, okay. Dave, you have a thought first?
I mean, if you want, why don't you just start off with like, hey, what are your expectations on earnings on the S&P 500 for 2023? Because like you could ask 30 people and you'll get like a football field of different options from like 180 to 240. And I feel like everyone's kind of waiting for this shoe to drop of earnings. My thesis is they might take longer than they expect, but it's coming at some point. But like, what is your and the GA's team's viewpoint on that?
So we don't have an exact forecast, but I'd probably put it somewhere. I'm definitely not in the bearish camp on earnings. 180 would be a surprise to me. Let's call it, 215, 220. And here's why I'm not as worried that earnings are going to collapse. And the reason for that is, we're actually a little bit more sanguine about a soft landing. And it doesn't mean it won't be a technical recession, but we're not in the camp that you're going to get a hard landing. And the reason is we think that the labor market is going to stay relatively strong. Consumer balance sheets are decent. Corporate America is resilient. So we're not looking for a big contraction. And here's where I think the math gets interesting. Let's even say, GDP next year is down 1%. We still think we're going to run 4% inflation. So that leaves you with nominal GDP of around 3%. And I'm probably lowballing it a bit. Our best guess is for next year, nominal GDP is up about 4%. Now, a lot of things could happen. Margins could contract a lot. They're still close to record levels. Wages are elevated. But if you go back in history and you look at periods when NGDP was rising by 4%, that's an environment where earnings can actually go up next year. So we're not of the view that we're going to get this collapse in earnings. And one of the implications of that is we've actually been buying credit. We've been buying, been adding high yield, we've been adding IG. And the reason is we don't think we're going to get one of these massive, spikes in the default cycle. So while equities are going to still struggle with the multiple, if we don't get a hard landing, if earnings don't collapse, we think that actually there's some good opportunity to put spread and carry into portfolios.
I guess I struggle on the top line as well, right? We've been an economy that for like 10, 12 years has grown on the back of the consumption of, quite frankly, like the top 10%, and they are not spending based on their revenue or their income. They're spending based on asset appreciation, which we've seen a contraction of across the board. So like, who is spending this money at record levels next year when savings rates are down and credit card debt is high? Like, I know a lot of people are looking at like the balance sheets of the lower class and saying that's actually really strong, but that's not who's really driving the spending in this economy. So like, how does the rest of the economy that we've been kind of resilient on from a spending perspective, like continue at that pace beyond their disposable income?
No, I think there are a couple of answers to that. The first of which is you still have probably about 1.3 trillion of excess savings that fiscal policy put on balance sheets in the U.S. So completely agree. Look, people are dipping into that. the savings rate is low, but you put so much stimulus out there for a long time, people couldn't spend it on anything. So there's still some excess savings to work through. Second, I don't know if you call it revenge travel or revenge spending. It is remarkable how well the service side of the economy is holding up. Whether you look at concert tickets, sporting events, we all heard the stories about what Taylor Swift tickets were going for a month or two ago. People are still looking to spend because after a couple of years of being locked up, we're still seeing a big bid for travel, entertainment. That will start to fade. We don't think collapses. The last part's the most interesting. This is also the part that I think is going to be dependent upon whether or not the Fed can get inflation down. I think you raised a fair point. Who's going to spend? Traditionally, when you get the slowdown, when inflation's low, it's hitting lower middle income families the hardest. There's definitely some of that. We've heard the stories, but a couple of things are actually working. One is gasoline prices are down. That is a huge swing factor for a lot of consumers. The other thing is when you look at the labor market, job growth is slowing, but it's still really robust. One of the reasons we think it's going to stay more robust, and while we don't think we get a hard landing, is a lot of those jobs are still missing several million workers. And those jobs tend to tilt towards lower middle income individuals. So where are you missing workers? You're missing, call it 800,000 in hospitality. Quit rate in hospitality spiked to 6%. You still have not gotten back those workers. You don't have enough healthcare workers. There are not enough teachers. So probably a lot of what we do, or whether you're in tech, you're going to see, outright job losses. But in a lot of the areas that are driving that middle part of the income distribution, we think the labor market's going to hold up really well because too many jobs disappeared that have yet to come back, and companies are still scrambling for help.
So Russ, talk to us a little bit about fixed income right now beyond just the high yield. How are you managing duration? And do you have bank loan exposure? And by the way, is there a context when you give an answer? Is it a specific portfolio you're speaking to, or just generally?
Yeah, no, I'd just say that what I'm going to describe, we've been doing across Global Al, across the GA selects, regardless of the profile. So what are the big contours? Big contours, we are still underweight duration. And for a 60-40 portfolio, to kind of put a finer point on it, we're underweight duration by somewhere about 0.7, 0.8 years. And to put that in context, a year and a half ago, we were underweight. We actually had a negative duration. We were outright short. So we've brought a lot of that in. Our view is that you're going to get the long end of the curve is going to be somewhat resilient because there is a lot of cash on the sideline for pensions, sovereign wealth funds, that is keeping the long end of the curve lower than it would otherwise be. So, again, I think if 365, wherever the 10-year was today, we'd be modestly short duration. If we go back to 4.25, we'd probably close a lot of that short down because we do think, the economy is going to soften. The Fed maybe doesn't go quite as far as they're talking about. Maybe it's, 5, not rather than 5.25. And I think as you get into the low to mid 4s, you buy some of the duration back. What else are we doing? Well, we're emphasizing carry and spread, as I spoke about. We're doing that in really, 3 areas. We're doing it in IG, we're doing it in high yield, and we're doing it in securitized. We're not really doing much right now in emerging markets. We actually like high yield better than loans. So I'd say those 3 areas, within a 60-40 portfolio, that's probably about 20% of the weight right now, with a little bit more of a tilt to high yield and IG than securitized. But the basic thesis, again, we don't think we're getting a hard landing. We think that default rates stay reasonable. And we think the equity market's going to chop around for another few quarters. So in that environment, what can you do? Well, our main theme is you get income in the portfolio. We're doing that in 2 ways. We do that in carry through the fixed income part of the book and the ways I just described. And we do it from overriding some non-trivial part of the equity book. Vol has come down a lot at the index level. It has not come down as much in single names. So, if we see names at the top of the range and we think it's getting a little stretched, we'll take advantage of that elevated vol to get some more income in the portfolio. So, generally in the fixed income, again, it's keep the duration modestly underweight and get high quality carry. I think those are the two big takeaways.
Okay, so I'm not going to add a question, but Paul in here has a question that is directly linked to what you just covered. So I'm going to go to him about his questions about financial conditions of the fixed income market. So Paul, go ahead.
Well, one of the subject I almost never hear mentioned is we've managed to go from a balanced budget 20 years ago to $32 trillion of debt. And if the interest rates stay at 4%, the interest alone on the debt's over $1 trillion a year. And in 2019, regardless of your politics, $1 trillion tax cut was given every year. So with a $2 trillion deficit pulling the economy down, my question was, when do you think, which did happen when President Obama was president, S&P lowered the United States credit rating a notch? And I can't imagine it not happening again. And what would be the impact if that happens? Because how do you deal with a $2 trillion deficit every year?
Yeah, it's a great question. That's why I wrote a book about this about 11 years ago when it was a $10 trillion deficit. So clearly things have not gotten better. Look, I think at some point, we are going to probably see another downgrade. I don't think it's imminent because, the U.S. still has certain advantages, which I think everyone knows, reserve currency, still a safe haven, but it's going to do a couple of things. I throw one more thing in that also is going to make this worse over the long term. And that is 10 years ago, people, again, to your point, regardless of where you were in the political spectrum, most people thought defense spending was going to be down and stay down. And now we're in a world where, this year we're going to go $850 billion in defense. If you look at what we were spending during periods of the Cold War, that can certainly go higher. So I do think there's a fiscal squeeze that happens, and you're right, it happens as rates climb, which is another reason you got to wonder how much does the Fed let it climb? At some point, do they think about other tools, whatever version of financial repression, which governments have used in the past. But I do think that we are going to be in an environment where neither interest rates nor inflation, and this is partly, maybe largely due to the fiscal situation described, neither rates or inflation are going back to the level they were at during the last decade. We're not going to have these conversations about, inflation at 1.6% or the 10-year at 1.5%. It doesn't mean, again, we're going back to 70s level bond yields, but I think we're in an environment where inflation is probably structurally higher, and that, clear, as everyone knows, is one way you can deal with the excess debt. Rates are higher because there is a little bit of a risk premium associated with the budget. Rate volatility is higher, inflation volatility is higher, and that is a different environment than we've had over the last 20 years.
Yeah, and I don't necessarily agree with the stance, but there are many people who are saying like the capitulation moment is really when Powell changes the inflation target from 2% to maybe something higher than 2%, as you're seeing other central banks around the world kind of like move up their upper bounds. But my question to you is, like, based on what we saw in 2018 and what we're seeing in the last year, couldn't it just be possible that like the real damage from tightening is the QT and not the interest rate hikes? And that's like yet to come, and that's going to come in mass next year. And like, in 2018, we were all terrified of the small interest rate increase, but there was also a lot of QT going on at that time as well. So like, is the QT that's coming on as a follow-on effect to the interest rate movements potentially more damaging for the economy than the interest rates itself?
I think it might be. I think it's a hard question to answer, and I'll admit that I don't have a strong opinion, partly because we've never experienced QT like this before. As you point out, the other efforts have been pretty modest, and again, you go ask 10 economists, you get 20 different opinions about how QT works, whether it works. The same with QE. My guess is that I'd say two things. One, I do think that the withdrawal of liquidity, of which QT is the big driver, is going to cause more train wrecks. I don't know if it means the whole economy is going to suffer, but I think what we've seen in crypto over the last year, that to me is a function of what happens when you go from record amounts of liquidity to financial tightening. And to your point, that continues. My other guess is that the Fed is not going to shrink their balance sheet nearly as much as perhaps they've spoken about. And, it's one thing to keep raising rates because inflation is still stubbornly high, but it's not obvious that they're going to get as aggressive on QT, partly because it's not clear to anybody what the trade-off is between QT and rates. So my guess is that QT at some point will be moderate relative to what's been talked about and relative to what maybe people were afraid of. In other words, the Fed's going to keep a bloated balance sheet for a very long period of time.
Hey, Lily, you want to go with your question? Then I'll follow up with mine. You're muted.
Now?
Yes.
Perfect.
Okay, thank you.
Happy
I
holidays too.
actually first heard Mr. Koesterich speak in 2008. You came to Northern Virginia and you talked to us advisors at the Western. And
Okay.
I said, remind people about 2008, what was happening at that time. And I really like your quote that you said that finding the market bottom, why is a process, not a moment, and earnings will be key. And is that still the key for market bottom? And my next question is, can you talk a little bit more about the move index?
Sure. So on the first, look, I do think earnings are the key. And again, if you believe there's a hard landing and we're going down to 180, then I think you still want to be selling stocks because, that's an environment where it's very hard to argue as a bottom. I think the earnings are going to hold up, as I said, because I don't think we're having a hard landing. The other thing which will determine if this bottom is lasting is, does the Fed stop where the market thinks it's going to stop? If the Fed is going to stop, in the zip code of 5%, then I think even though the market chops around, there's a decent chance that 3,500 level we've seen is probably a tradable bottom. If the Fed is going to have to go to 6, then I think, you can go lower, potentially much lower. So those are the two things I'd watch. The move index, for those not familiar with it, the move index is the rate cousin of the VIX index. So what you're really looking at is treasury volatility. And, it's one of those indices that you could pretty much have ignored for, most of the last 10 years, but suddenly this year became a very important factor. It became an important factor because unlike other periods, rate volatility was driving equity volatility. So what was happening in the move, definitely translated into what was happening in the VIX. And the other thing is that, when you go back in history, and we did a blog post on this for anyone who's interested, both the level of the move index and the change in the move index do have an impact on equity markets. Now, it's been so long since the move index changed enough for anyone to really care, but there have been periods, as you look back over the last 20 years, where this does become an issue. Now, the good news is we think I'm more convicted that treasury volatility has peaked than I am that equity volatility has peaked. And if that's right, if we're again getting closer to the end of the tightening cycle, if we're going to start to move to quarter point increments in 23, even if the Fed goes to 5, rate volatility is likely to grind lower and measured by the move. Why is this important? Because if rate volatility grinds lower, that is a more benign environment for equity markets. Generally, the month-over-month change in the move is relevant for the month-over-month change in the S&P 500. And if earnings are going to stabilize, again, call it in that 215, 220 range, we have an environment where rate volatility is declining, then I think you can actually have a decent year next year, though it may not start out that way. So I do think this question about the move index and rate volatility is important in an environment where, again, I'll say financial conditions are probably one of the big drivers for all risky assets.
So I got to tell you, I needed the breath of fresh air that you're giving me, because we don't hear a lot of optimism these days. So I find it very helpful. But along those same lines, we're the ETF think tank, right? But we do traffic in closed-end funds every so often. And David identified a fund that you're involved with, that you manage. I think we can say the symbol ECAT, And here I can buy my buddy Russ at a discount of almost 20%. Talk to us a little bit about how you specifically have that strategy position, because I think it has a fair amount of cash. It's unique in other ways. And then what do you do about that discount?
Well, I'm hoping you take advantage of it. That's, again, I mean, it's not just that fund. I think, as everyone knows, whether you're looking at, some of the tech closed-end funds, or you're looking at muni funds. I mean, this has become a year where, you're getting 10, 20% discounts on a lot of these closed-end funds. And you're right, ECAT is trading at a 20% discount. So for those not familiar with it, ECAT is a closed-end fund we launched in September of 21. And again, I co-manage it with Rick Reeder and David Clayton. And the fund is basically a franchise extension of Global Owl. And where Global Owl is basically aimed at total return with less volatility, ECAT has a different mandate. The first mandate is to give 6 to 6.5% annual distribution. So this is a fund that is more geared to people that are looking at current income. And the second part of the mandate is that it is an ESG fund. It's an ESG fund with I think, an interesting spin on it. It's not just about what we don't own. It's also leaning into a lot of the themes that generally score well on ESG metrics, such as the MSCI. And then the final thing is, because it's a closed-end fund, we have the opportunity to have more strategic holdings in privates, whether that's private equity and credit, than you can practically do in a 40 Act fund like Global Owl. So, again, it's a unique fund. I think, the 20% discount, in my opinion, creates, an interesting opportunity. And it is a fund that I would say is primarily geared at investors that are looking for current income and, again, are looking for an ESG mandate. Now, what do we do with that? We're pretty much doing many of the same themes we're doing within Global Owl, but they're geared towards those mandates. So there is a focus on fixed income. We've been buying a lot of some of the beaten up growth names in ECAT. And one thing that's interesting, this is a little bit tangential, but I think it's worth talking about. Because everyone knows it's been a terrible year for ESG, like horrendous. And it's, the first time since people started seriously putting money to work that we've had a terrible year in ESG. Matter of fact, we have signals we use in our systematic models that track ESG and changes in ESG ratings, and they work phenomenally well up until about 10 months ago. But the thing that's been happening in ESG, in my opinion, and this is directly related to ECAT, is had much less to do with ESG, but more with the fact to do that when you buy ESG, you're also buying growth. You're taking a growth tilt in the portfolio. You look at any ESG fund relative to a more generic benchmark, it's going to lean growth there. So I think the opportunity here is not that everyone suddenly woke up and decided, you know what, we're kind of done with ESG. But if you're going to invest in these funds, the side effect is you get a lot of growth. And for all the reasons we've been discussing, the backup in rates, particularly real rates, growth has had a horrendous year. If you're of the view that growth gets a little bit of a rebound next year, my guess is ESG will go along for the ride.
So I think one of my favorite things about the closed-end fund structure is that you don't have to meet redemptions. And I don't think enough people fully understand that. And in today's day and age, the value of actually not having to meet redemptions could be pretty significant. What I would like to ask is, what do you guys do on a structural portfolio level with leverage? Is there leverage on this portfolio? Is it consistent over time? Does it change over time? And how far are you into your private allocation, whether it be venture or debt or PE? My understanding last time Dan Weisskopf and I looked, you didn't have that much allocation on that size. On that side of the portfolio, but like, where are you on that in terms of like deploying capital? Is it something you're actively looking for right now? And
so, yeah. I'm sorry. Yeah. So on the leverage, this is not a levered fund. Our other offering, BCAT, which is the same one, it's a year older, does use leverage, but right now that we have zero leverage, just given what's been happening with rates. So ECAT is not levered. We can go up to 20, 25% on the privates. We're still early in the process, given what's been happening in markets, more in the single digits. That will grow over time. We've actually been leaning consistent with our public equity and fixed income strategies. We've been taking on credit faster than we've been taking on private equity. And again, the reason is right now you've got opportunities to add a lot of carry to the portfolio. Again, this is still a portfolio that's designed for current income. So my guess is we will continue to add at a decent pace in 22, given the change in valuations, and probably, we're going to probably take up the credit part faster than the equity part, the private credit.
And I'm sorry, Cynthia, you go ahead.
Yeah, no, I was just going to ask you, Russ, about if I can just go back for a quick second to the ESG conversation. I was wondering, we've always wondered why ESG investing took off in Europe so strongly, and in the US, we always say it's really behind. And the argument I've always heard is because US investors are really focused on performance first and foremost, other than the principle of the whole thing. So did you confirm that this year? I mean, when performance falter, everybody just turned really negative on ESG. And if that's the case, what do you see as the conditions, to use our word of the day, for ESG investing and, themes linked to ESG investing next year?
No, this is a great question. And, you're exactly right. I mean, I spend, not the last few years because no one's been traveling, but I spent a lot of time in Europe. Europe is much, I think ESG is much further along in Europe. Now, part of that reflects the fact that in Europe, it's much more of an institutional market. So if I compare the institutional appetite of the US versus Europe, there's not as much of a difference. But you're right, ESG is further developed in Europe. It tends to have an emphasis on the E, although I think that the social part is also big, although the interesting thing in Europe is you get different definitions of it depending upon where you go. And we launched an ESG fund in Europe a few months ago, and it's challenging because the focus in Germany is different than the focus in Belgium, which is different than the focus in France. Now, why is it not caught on as much in the US? I think there are a couple of reasons. One, the US has the largest retail market. For a lot of ESG investors, again, they're institutional. It is a matter of policy. It is a political decision, it is a corporate decision. If you look at institutions in the US, you see some of that, but honestly, it depends where you are. In New York, there's a very strong focus on it. In California, there's a very strong focus on it. I've traveled a lot this year to Texas, Georgia, Tennessee, and I'll say that in general, the focus is very different, as we all know from reading the news. So I do think that there's much less, there's a less homogenous view in the US about the value of ESG, what constitutes ESG, is this even desirable? Among retail investors, I think you nailed it. I think it's a couple of things. It is performance related. In my estimation, there are some investors, retail investors, that are focused on ESG products, but it is still a smaller market than when you talk to institutions. And why was it so popular in 18, 19, 20? Well, it was doing really well. But again, this is where I think it gets interesting, and that is, when you look at ESG, if you just look at an ESG portfolio and look at it versus the market, you come to one conclusion. If you do something a little more sophisticated and you decompose that return, what you find out is a lot of what drove ESG over the last 5 years was what drove the bigger market moves. It was mega cap tech, it was communications, it was healthcare. It was a lot of basically growth themes that did really well in an environment where the discount rate was close to zero. And then when that changed, they did really poorly. So I think the best thing that could happen for ESG with US retail investors has very little to do with ESG. It's growth stocks come back.
I'll hop in real quick, and then Jim, we'll pass it over to you. Have you purchased BlackRock closed-end funds in BlackRock mutual funds or JA models? Like, at what point, at what discount does it make sense for you to be like, well, we're just getting exposure to this on sale?
It is something we can look into. It is, just to give you a short answer, also there are regulatory issues there, but we have looked into doing that, and it is given the level of the discounts, it's definitely something that you want to examine.
Jim?
Yeah, hi. Thanks, Russ. I like to think of BlackRock as an organization that doesn't get surprised very often, but 2022 has been kind of a wacky year. What was the biggest surprise from your perspective, and what would you call the biggest surprise we might see in 2023?
You know, I would say the biggest surprise, honestly, was what happened in the Ukraine. You know, I think we probably underestimated inflation. We underestimated where the Fed was going to go directionally. We probably got it right. But I think the one thing that was not on anyone's radar screen a year ago that, you know, I think is, I don't know if I call it the dominant market factor, but it's played a large role. It's exacerbated inflation. I think it has long-term geopolitical impact is what happened in the Ukraine. And, you know, we are fortunate to have some really smart, informed people when it comes to geopolitics and these sorts of issues. And I think even they were surprised. So that was probably the biggest shock of 22, as I think it was for a lot of, not just investors, for just everybody. The biggest surprise for 23, I'm actually going to, again, maybe this is the whiskey I'm sipping, but I'm going to go out and say something positive. I think that the surprise for 23 is I think the U.S. economy is going to prove more resilient than a lot of people expect.
Damn, that would be a great surprise.
Yeah. Dan, I don't have a question, but I want to say we should do a show where we just like make a bingo card for 2023, right? Like, you know, ESG is finally accepted, or Dogecoin replaces Bitcoin, crazy shit. Like, because this year the bingo card has just been insane. But you go ahead with your questions.
Well, a quick question, and then we'll go to Ray, I guess. Warren Kaplan asked the right question on ECAP. I think, you know, the dividend of 6% is compelling, right? How confident are you in maintaining it? Okay.
Well, what is the makeup of that dividend too? Like how much is return on capital?
And how much coverage do you have? You might be earning 8% and paying out 6%.
Yeah, no, look, I think right now I'm very confident, and we can return capital, but we also, you know, again, it's capital gains, it's interest, it's dividends, and it is any income from selling vol. I'd say in this environment, look, I am more confident we can maintain that distribution in today's environment than I was when we launched it. And you think about the change in rates. You know, right now you can get 5% on short-term IG. You can get 7, 8, 9% in high yield without going into single Bs or craziness like that. You know, we're finding names, particularly in the in some of the value spaces in the market that have very attractive yields. We can complement that by selling vol. So look, this is probably a better environment for harvesting yield than we've had in the last 15 years.
Has BlackRock ever transitioned a closed-end fund to another 40X structure in the past?
Honestly, I do not know the answer to that.
Point of clarification, Warren also offered up that what he's seeing is that the current yield is 8.87%. Thanks, Warren. Appreciate it. Ray, you're up, man.
Thanks everyone. Thanks, Russ. Looking globally, are there particular areas or what areas people like globally, either in the equity or fixed income areas? And conversely, what areas for 2023 might you say be better to maybe allocate away from too much excess risk?
Yeah, so I think the short answer is in the fixed income, we're still pretty close to home. We've got a little bit of European high yield and IG. Our EM fixed income exposure is still pretty small. We've got some Brazilian bonds that have done well, and we're happy to clip that coupon. But I think, you know, given the fact that you are going to get this global slowdown, and Europe is going to go into recession if they're not already there, I think, you know, particularly for credit, we prefer closer to the U.S. On the equity side, we are still overweight the U.S. The reason for that is quality. We like quality as a theme. You know, all the debate, value, growth, I think ignores some of the other tools at your disposal. You know, one of the best styles this year was min vol. But because we do like quality going into 23, it still leaves us with a US bias. Having said that, there are areas of the world that I think people want to take a look at. The one caveat I'd say is that, and again, I know this is an ETF forum, a lot of our international exposure, we really want to pick the names. We're more reluctant to do it at the index level. So I can't say, buy France or buy Japan or buy Hong Kong. What do we like? We like European staple companies, cheap, high yields, and they're global companies that we think the earnings are going to be consistent. We actually like European luxury good manufacturers. We like some of the European auto names, some of the semiconductor names in Europe. You'll notice I haven't said much in Japan. We're very underweight in Japan. Now, what I would say is that I think there are actually names in China that are worth a look. Now, China's become a really hard market to invest in. And full disclosure, we probably own a third of the assets in China that we owned 2 years ago. We've got no Chinese debt. Our equity exposure is half of what it was. Having said that, China at least tactically looks interesting. They've completely abandoned zero COVID. They're going to stimulate the economy. The market is down, significantly from its peak. And there are areas in Chinese consumer names, in China tech, that actually would be buying at these levels more for a trade than an investment. But that's actually the other part of the world we put a little money to work.
So Russ, you mentioned both China and Brazil. And one thing I heard as of late that I found interesting is kind of based on what happened in the UK, that this liquidity bubble, similar to how it's like affecting the upper class on the firing side, it's actually affecting the developed world a little bit more than those upper tier emerging market countries, maybe such as China and Brazil. So I'm curious in that, does the US have a potential for a crisis that just happened in the UK? And what are your thoughts on the US dollar versus emerging market currencies? Because based on your viewpoint there, I'm a little surprised that you don't have a little more exposure to some local currency in the EM space in Brazil and other parts of the emerging market space.
Well, we do. So the short answer is we do like some of the EM local currencies, but we've been doing it actually in a different form. We've been basically owning the short-term paper, and we've been selling vol to complement the yield. But I do think that there is an opportunity EM currencies, and right now, probably I like that trade better than the dollar against, let's say the euro or the yen against the dollar. Our view on the dollar is that you've put in the peak. Again, this reflects the fact that while I don't think the ECB and certainly not the BOJ is going nearly as far as the Fed, nor will the Bank of England, they've got their own issues. In Europe, you've got stubbornly high inflation, same in the UK, and Japan has an unsustainable attachment to yield curve control, which is already starting to break. So I think the dollar is going to probably be more of a two-way market. If I had to bet, I'd say the dollar ends the year lower than it is, but not by a ton. So we're actually much more close to home in the dollar than we were, call it last summer. At the peak in our 60-40 global AL, we were 1,200 basis points overweight the dollar. We still have a little bit of an overweight to the dollar, but it's less than a fourth the size. It's sort of spread out, between the euro, yen, Swiss franc, and the Taiwan dollar.
Do you have a prediction about the war
In the Ukraine?
I know. I'll keep going. I have lots of questions. So because he's not going to answer that one, unless you want to answer that question. You're welcome. You're welcome to answer that question.
Prediction. Maybe that's the right answer. No, unfortunately, I think this is going to continue.
So what are your thoughts on commodity producers versus underlying commodities, maybe ex-ag in the energy space? It seems like the stocks are doing a whole hell of a lot better than the actual underlying commodities. And so there's a whole lot more faith into it. We talked earlier, it was a little bit of a blind side, but S&P, this is not to do anything with your portfolios. S&P's growth calculation now considers 12-month performance, a literal momentum calculation as one of the top 3 criteria in S&P's growth calculations, right? So like energy names are now in the growth side of the portfolio as well for S&P's lineup. Like, it just feels like there's this divergence from the commodity producers and the underlying commodities, where the commodities have gotten a whole lot cheaper and the commodity producers haven't gotten too much cheaper.
Yeah, I think that's fair, but one, I think depends on the commodity. We actually, and I'll try to get specific. We still like the energy names. We're over at energy. The other place in commodities we like the agricultural commodities. What do they both have in common? Supply constraints. In our opinion, supply constraints that are more structural, that don't go away. I think you're right. The commodity names have done better than the underlying. It's kind of funny. You look at the commodities, you think this has been like it's all green. Oil is up, whatever, 5%. Most of the industrial metals are down on the year, and ags are mixed. But why are the commodity producers doing well? One, I think they're still very cheap. You're right that the commodities have come down, but even if you extrapolate current levels for oil, for gas, these companies are still very, very cheap in terms of valuation. And the second thing is, and I think goes to your point, energy in particular has become a momentum play. If you look at you guys know this very well, you look at a momentum ETF like MTUM, it's this almost unprecedented combination of defensives and energy. It's going to be, it's got a high weight to healthcare, a decent weight to staples, and then this huge weight to energy. Why is that? Well, I think the simple answer is it goes back to the environment we're in. If you have an environment where you're worried about slow growth, which is most of what we all fixated on for the last 12 years, there are lots of hedges. I can buy defensive equities, I buy utilities, I buy duration. If you're worried about inflation, there are very few things that work. This has been a year where a lot of things fell apart. But if you looked at history and you knew inflation was going to be this bad, the one thing that worked historically that has worked spectacularly well this year is you buy energy stocks. They have been the most consistent inflation hedge, not gold, not tips, certainly not Bitcoin. It's been energy stocks. And that continues to work for the most part. So, I would say the reason I think the energy companies have outperformed, in addition to the fact that they're cheap, and you can have I think a rational basis for believing oil is going to remain elevated, is if you think inflation stays sticky, there are not a lot of other things that you'd be that confident in that are going to work as a hedge in your portfolio.
Dan?
Yeah, no, listen, Russ, this has been great. Literally like 11 years ago, you wrote about the conditions that we're experiencing right now. And I encourage everybody to read the book. I think we're going to wrap up here. It's top of the hour. And by the way, for those who care, Elon Musk is taking questions on Spaces. So you can,
Are you trying to kill our audience like single-handedly, DW here? Come on.
Well, we're wrapping up. We're wrapping up. So
we're wrapping up, man.
I'm glad we didn't have to ask Russ about Tesla. I'm sick of that question. So
as am I.
Yeah. Listen, happy holidays, Merry Christmas, all the fun stuff to everybody. We really appreciate all of you spending the year with us, and we look forward to doing even more creative things next year. We've in the next couple of days, we've got a relaunch of the ETF Think Tank website with all kinds of more content and easier ways to access everything. Feel free to reach out to any of us, suggest guests, suggest other things we can do to work with the advisor and investor community, especially those interested in ETFs. Russ, as always, thank you very much. I mean, the insights, like people just got a masterclass in the conditions of the current market. So we appreciate that. And with that, we'll wrap up here.
Our favor in 2023.
No
Thank you,
war in
everyone.
2023.
Yeah.
Happy holidays, everybody.
Happy holidays.